Okay, welcome everybody to this episode. I want to go over a couple things. I want to go over the Story Fund, which is my secondary portfolio based off of Peter Lynch, who, if you haven't seen the other exclusives, they look like this. They have Peter Lynch on the front. There's one of them with the Domo CEO. There's one about the New York Times. And then there's a lot that have Peter Lynch on the cover. There's a reason that I have Peter Lynch on the cover of these episodes. Peter Lynch was an investor that really focused on the story of a company. He was an investor that invested in rapidly growing companies. Not all of them in his day was tech. A lot of them were like Dunkin' Donuts. Those were companies that grew 10 times in size. So they might have been different companies, but the same thing regardless. He looked for what companies would go up 10 times in value. He termed them 10 baggers. He's the one that came up with that. This guy is such a good investor. If you read any of the books that he's written, it will enhance your investment knowledge a lot. And I like the fact that he does not try to outsmart you. When you read about Peter Lynch and you read the books that he writes, he talks about it in such a frank and plain manner. He says that investing is not that difficult, that everybody can do it, that you look at a company that's going to grow. If the company's going to do well, the stock is going to do well. He doesn't try to use fancy investment terms. He doesn't have to impress everybody with his convoluted patterns of logic and all these different things that other investors try to do. Peter Lynch was very straightforward and his returns were phenomenal. He beat the market by over double for about 13 years straight. During his tenure in Fidelity, he really grew that brokerage to be what it is today. He's part of the reason it's such a household name. So I really like Peter Lynch. That's what I based the Story Fund off of, was investing in these very storied companies. They're companies that they have a specific story to play out. I look at that, I see if they're fulfilling what I think they're going to do. This also happens to be a portfolio that is very aggressive. And by that, I mean, it has a lot of volatility. These are tech companies. They're companies that usually have subscription models. They're usually cloud companies. They're companies that they trade at high multiples because investors really want to own these ones. So a lot of them trade around quite a bit. They can change in price pretty drastically. And we saw that over the past week. If I go to the 1 week view here, the Story Fund was down 5.3%. So if I compare this to the S&P 500, the S&P 500 pulled ahead of the Story Fund over the past week because what happened was a vaccine was announced on Monday. And what that did was drop all these companies that are the tech companies, all these high-flying companies like Netflix and Facebook and Spotify and Peloton. All these companies came down a lot. Meanwhile, the companies that have been really damaged by the coronavirus got a little bit of a boost. And we can see that in the markets. The S&P 500 over the past week, it went down only 1.68%. The Dow Jones went up a little bit, and the NASDAQ went down. It went down about 9.68%. And again, that's because of the vaccine news. So right now it's a little bit rocky with this portfolio. If I go to all time, I'm still up $1,500, but this is a long-term portfolio. And I am confident that even if we have a vaccine, even if we have a solution to the coronavirus, I think these companies will do fine. Peloton might contract in its multiple for a bit as investors are hesitant of it. They might think that it's not going to do as well in a post-coronavirus world. I don't really believe that. I think people are going to be just as lazy post-coronavirus as they are pre-coronavirus. Any company that offers a lot of convenience, I think will do well. You have all these companies that are making products very convenient. Peloton does that. And so I think these companies will do really well. So we'll see what happens. But regardless, this is an aggressive portfolio. It's focused on a lot of tech companies. I think these are some of the best companies in the world. In this episode, I want to explain why stocks go up. What causes stocks to go up in price? And this is actually a little bit of an in-depth subject. This is mostly concerning growth stocks. So let's go ahead and go over to the whiteboard and outline a few reasons that these companies go up in price. So let's go over to the whiteboard and talk about this for a minute. Why do stocks go up? This is a question that I've looked for an answer. It's an honest question. What makes the price of a company go up? If you're investing in a company, what things can you look for that will have an effect that will cause it to go up? There's actually a couple different things that can make this happen. First of all, let's talk about what the value of a company actually is. The value of a company is its market cap. That is literally how valuable the company is. A lot of people, when they get into investing, they're brand new in it, they look at the share price. They see that a company's trading at $5 a share, and they think, okay, that company's worth $5 a share, and this company's worth $100 a share. So this $100 a share company must be far more valuable than the $5 a share one. Not necessarily, it can be, but that's not always the case. The market cap is what determines the value of a company. So if we go over to the stock picker here, you can see this. Apple is the most valuable company in the world with a $2 trillion market cap. If I click on Apple, the share price is $119. So that's the share price of a $2 trillion company. Whereas Microsoft is worth 1.6 trillion. It is a less valuable company than Apple. But I click on Microsoft and the share price is about double. So this is where the share price can be misleading. The value is in the market cap. We could also look at Amazon, which currently is worth less than Microsoft and Apple, and its share price is $3,128. So again, look at the market cap, ignore the share price. When you're doing valuations on companies, ignore this. Don't look at it. Don't get influenced by a big number for Amazon and a small number for Apple. Amazon might be a much cheaper company than Apple. The share price has nothing to do with it. Now, what is it that actually changes the market cap? What is the logistics of this? What makes the market cap of a company go up or a market cap go down? That is supply and demand. This is where a lot of people lose track of reality. They think that the market cap is determined by a lot of different things. They think it's determined by the economy. They think it's determined by how the company's doing at the moment. That's not what determines the market cap. The market cap is directly determined by supply and demand. That's it. That's the only thing that determines the market cap is supply and demand, not the economy. If the economy is doing great, that doesn't mean that the market cap of a specific company will do good. If the economy is doing very poorly, that doesn't mean that the company will have a low market cap. It's not related to the economy. It's not related to anything else. Simply put, how much do people want to own this company and what are they willing to pay for it? That is the only thing that determines the market cap of a company. How much people want to pay for it, how much they want to own it. If people want to own a company and they're willing to pay up for it, the company market cap will go up. That's the truth. The company doesn't have to be good. It doesn't have to be generating profits. As long as people are willing to pay for it, the market cap will increase. So just to do a recap so far, the value of a company is synonymous with its market cap. The market cap is representative of the value, not the share price. Supply and demand is what determines the market cap of a company, i.e. the value of a company. The more demand the company has, the more people want to own it, the bigger market cap it's going to have. So a company like Apple that has a huge market cap, the reason it has a really big market cap is because there's a lot of demand for that company. A lot of people want to own it and they're willing to pay a lot of money for it. Now, that's functionally how the stock market works. It's based off supply and demand. People buy these companies and that drives up the market cap or the value of the company. But what is it that creates demand for a company? What can we look at if we're saying, hey, we want to invest in companies that are going to have future demand, that people are going to want to own in the future? What is going to create demand for these companies? Demand of a company is driven by two major factors. One of them is business growth, and the other is re-rating of a company. So I'm going to go ahead and go through each of these and explain what they mean. So let's talk about business growth. This is not market cap growth. This is literally the business itself expanding its stores, expanding its customers. There's a lot of different ways to gauge growth. I'm going to go through the different ways that we can gauge growth and which ones I think are the most important when looking at growth companies. But in a basic sense, business growth means the company's expanding. When the company expands and it grows, that makes it more desirable to own. People want to own a company that's growing more than one that's just staying the same size or even shrinking and becoming anemic. So if a business is growing, that creates desire. When people desire to own a company, that creates demand. The more demand the stock has, the more inflows of money will go to it, and the bigger the market cap will grow, which makes the stock go up. Now, business growth can be gauged in a variety of different ways. There's tons of ways to look at growth of a company. Is it revenue growth? Is it operating income growth? Is it the operating margin growth? Is it the subscribership growth? Is it the amount of monthly active users for a tech company? Is it the amount of hours that people are watching on your movie service? Is it the amount of exercises they're doing on your exercise platform? There's a bunch of different ways that businesses can grow. There's lots of different metrics you can look at. So looking at which ones are the most important is kind of up for people to judge. Which way a business grows and what's most important is somewhat subjective. There's people that value different aspects of a business growth over others, but I'm going to give you my things that I think are the most important aspects of business growth. First and foremost, we have revenue growth. For those of you who aren't familiar with these accounting terms, revenue growth is something you have to get familiar with if you're trying to invest in individual stocks. Revenue growth means the total amount of money a company took in. It doesn't take into account any expenses or overhead. It's not how much profit the company made. So a company might take in a lot of revenue and still operate at a loss. They might lose money every single year. But revenue growth is a total amount of money that a company takes in. So if you go to Domino's and you order a $15 pizza and you pay them $15, Domino's just made $15 of revenue. And they might have only made like $3 of net income, but the revenue is the total amount of money the company takes in. The reason that I focus on revenue growth for growth companies over net income is because that shows how much money the company's taking in year over year. If the company's expanding its revenue, it means it's taking in more and more money. It might not be profitable. They might be investing a lot of money in it and it might be operating at a loss, but as long as it's growing its revenue, that is a very good sign for a growth company. They can usually, if they grow their revenue to huge amounts, usually the company will be able to figure out its net income and become profitable later down the road. This is the same thing we've seen with all the big tech companies. With most technology companies, they start out focusing on their revenue growth. They grow that year over year, and they really don't make a lot of money in terms of profit. But they become so big, they grow that revenue to such a large amount that once they gain scale and size, they then focus on net income. So in the growing stage of a company, I think that revenue growth is much more important to look at than net income growth. You really shouldn't look if the company is becoming too profitable. The big focus should be if they're growing revenue year over year. And just as a rule of thumb, if you're focusing on growth companies early on, I would not focus on companies that grow their revenue at less than 15% year over year. Big established companies that are really slow growing ones that are stable, like Costco, Home Depot, Pepsi, all of those companies grow their stock at like 7%, 6% year over year. They pay a dividend. So if you're growing your company at less than 15% a year, you may as well just invest in one of these bigger companies that's already established. For a small growth company that you're expecting a tremendous amount of growth over the coming years, you want it to be growing at least 15%. Another aspect you can look at with the growth of a company is subscribership growth. Not every growth company has subscribers. Some of them, they're not the type of business model that's a subscribership model, but many good growth companies do. And they're not all tech companies. A lot of them just operate in many different areas and they all focus on subscribers. You can take an example of a company like DoorDash or Uber Eats. All of them, for instance, are moving to subscribership model as well. There's a reason that companies love subscribership model. It is a superior business model in almost every aspect. It is a way to have a good, predictable, growing stream of income. That predictability leads to a lower cost of capital. It leads to a higher multiple on the company. It means that they have a more predictable income stream. And as you know in investing, when things are predictable, that's preferable than having a company that you don't know how much money it's going to make every year. So subscribers in a company where they have a good retention rate and seeing that number grow over time, I think is also a really good gauge of the business growth. I look at the example of Disney. A lot of people, they focus on the revenue of Disney, which has gone down. So Disney has some aspects of its company that aren't growing right now. And right now, Disney Plus doesn't make up any amount of their revenue growth. It's really negligible right now. It's such a small amount. But their subscribership growth is skyrocketing on Disney Plus. So even though they're lacking in revenue growth for the moment, they're growing their subscribers like crazy. And I have to take that into account. When a company is growing massive amounts of subscribers, and I think that they'll be able to retain them in the future, that is going to be something that is very valuable later on. As we've seen with Netflix, they can find ways to monetize those subscribers later on. And overall, I personally think that subscriber-based companies are superior for a variety of reasons. I've gone over that in a lot of different videos. It's part of the reason that I have a Patreon here. It gives me more predictable income with this YouTube business. So I could rely on YouTube ads, but anything can happen with YouTube. It's not as predictable. The ad rates can fluctuate like crazy, but having a Patreon where everybody pays a small amount of money for the content creates a much more reliable stream of income. So subscribership growth is something that you can focus on as well, along with revenue growth. And many good tech companies have both of these. They grow their revenues at 15% plus year over year, and they grow their subscribership as well. And then the last point I'll mention on business growth, which is another one I think personally is one of the most important aspects of business growth, is market share growth. Is this company growing in market share, the total market share of their category, their competitors, or are they staying consistent, or are they shrinking in market share? And how much are they shrinking? This is definitely something you should pay attention to. You can look at examples of different companies. If a company starts off with only 10% of the market in their category, but then they continually take market share, that is a wonderful sign of that company. That is business growth. That will make the company more appealing. More people want to own it because of that, which makes the stock price go up. You can take a look at an example here. This is the example of DoorDash. This is a company that I'm heavily considering once they IPO. I'll look at the price. But take a look at the market share growth of this company. DoorDash is the one in orange here. We have the competitors like Grubhub in the blue, we have Uber Eats in the red, and then Postmates in the green. And you can see it started off, and all of them had similar market share. Grubhub had the biggest market share by far since the beginning. It started off with like 40 or 50% of the market share. Uber Eats also was the second leading in market share, and then DoorDash was the third. So DoorDash was at a disadvantage. They had a lower amount of the market share, but look what this company's been able to accomplish. Over the next 3 years, it has raced ahead in market share away from everybody else. And currently it controls 49% of the market share of these door food delivery services. That's incredible. That makes you wonder, what is DoorDash doing so good that these other guys can't figure out? Why did DoorDash take so much market share from Uber Eats and from Grubhub? These companies have already been established before them. They already held a lot of market share before DoorDash did, but then DoorDash did something to take their market share. So these three aspects, revenue growth, subscriber growth, and market share increase, like I said, in my opinion, I think they're three of the most important aspects of growth of a company. If a company has these aspects, if they're doing these things, they are headed in the right direction. They will become an appealing company to own. When the company's more appealing to own, that means more people want to buy it. When a company has more demand, that means that its market cap will go up, which is the value of the company, which means the stock goes up and you earn money and capital gains on this holding. So I think that if these three aspects, revenue growth, subscriber growth, and market share, are headed in a positive direction, you are most likely going to see capital appreciation on the company. And in my opinion, if a company's really struggling with one of these things, if it's losing market share, if the revenue growth is declining or it's slowing down like crazy, or if the company's losing a lot of subscribers, that's usually very difficult to reverse. The company's price will usually drop. That doesn't mean it's a value play. That doesn't mean you should keep putting money in it. In most cases, if you have a growth portfolio and the company's not able to do these things, if it starts trending in the other direction, I would sell out of it. Okay, so we know business growth as one of the key factors that drives changes in the value or the market cap of a company. Let's go on and move to the other factor that I outlined, which is a re-rating of the company. The rating of a company or a re-rating of it means that investors are willing to pay a different amount for the same company. So they might value the company at X, and then after certain events happen, they value that same company at Y. And the company really hasn't changed all that much, but investors just value it more. There's specific reasons why that happens. Let's go ahead and take a look at Apple. This blue squiggly line is the PE ratio of Apple over time. So we can go back to 2014 right here at the start, and you can see the PE ratio is around 15 to 17, but it mostly floats, let's say on average around 15. And then in just the past year, you notice this line goes up. This is where present is. Apple's trading at around a 30 to like a 35 PE ratio right now. Now, what would cause Apple to trade at such a high multiple? For a long time, investors were paying this amount. They were paying a 15 PE ratio. And then for some reason in the past year, investors decided that Apple's worth about twice as much. They're willing to pay twice as much for the company. What caused that increase in demand for Apple? Why did investors find this company more appealing and they're willing to pay more money for it? I think the reason why is the coronavirus. The coronavirus created circumstances where people valued Apple more than they did previously. They valued Apple's business model. Apple was completely functional throughout the coronavirus. Their business really wasn't hurt at all. They closed all of their stores and they still made billions of dollars. People were more glued to their phones than ever. Apple was able to launch their music service and streaming service. They're able to launch all their new products. People are still willing to shovel out lots of money for their phones and devices. On top of that, Apple's a very stable company. They have about $200 billion in cash. When you're in an uncertain circumstance, owning a company that has a tremendous amount of cash reserves all of a sudden becomes very valuable. You go, wow, I really want to have a safe company to invest in. Apple looks very appealing now. And then there's other reasons why I think investors were willing to pay twice as much for it. They offer a lot of communication devices with FaceTime and iPads and lots of homeschooling and learning devices. And it looks like maybe in the future, we'll be doing things through the internet even more than we were a year ago. With all these working from home and schooling from home, Apple devices are probably going to get used even more. So at the end of the day, Apple didn't really have to change too much with their business for investors to suddenly value it twice as much. They thought, wow, with the circumstances, with the coronavirus, the shifting of our digital economy, the shifting in consumer habits, these are probably going to stay for a long time. I'm willing to buy Apple even at a premium There's not many companies like this that you can put your money in and sleep well at night. So that's one example of a re-rating of a company. If a company gets re-rated, that means that people are willing to pay more for it than they were previously, or they're willing to pay less for it than they were previously. So Apple's one example of a re-rating of a company that happened over the previous year, but it's not the only one. Lots of tech companies like Apple also got re-rated, and they went up to higher multiples because people found them more appealing given the circumstances. So if you're looking at a company that might be re-rated, if you're trying to judge whether or not people are eventually going to pay a lot more for this company, there might be certain catalysts that you can look at. What is something that would cause investors to give more value to this company? And that's one thing that you can look at in the future of a business. I've made the argument many times that Disney will have a re-rating in the future. In the blue here, we have the price to sales of Disney. So that's one valuation metric you can look at. And in the red, we have the price to sales of Netflix. Notice that Netflix trades at a higher multiple than Disney. It trades at a higher price than Disney for the same amount of sales. The reason it does is because Netflix has a subscription business that, like I said, investors value at a higher valuation. Since investors like this subscription business that has predictable income, has a record low churn rate, investors are willing to pay a lot for that type of business. So Netflix trades at around a 7 to like 13, 14 price to sales, and Disney trades at around a 3 price to sales. So Disney is a fraction of the multiple of Netflix. And I've been saying for a while that as Disney grows its Disney Plus streaming service, you'll see this price to sales creep up closer and closer to Netflix. I think it will really get close to Netflix's. I don't think it will ever be the same as Netflix's or surpass it because Netflix is a pure play streaming service and Disney has a bunch of other aspects of their business. But I do think Disney will get an increase in its rating as investors begin to value their new business more. It's very clear to me that a streaming service is a much more valuable stream of revenue than distributing your content through movie theaters. Movie theaters are a one-time sale. They make $1 billion over a couple weeks and then they're done. Streaming gives you hundreds of millions of dollars every month, and it's something that's residual. So that demands a higher multiple. I think that Disney will have a higher multiple down the road. This is an example of something I think will change the market cap of Disney down the road in a few years. I think that they'll get re-rated. I think that investors will realize the value of this new business, the streaming, and they will give a higher multiple to the same company. So this is what I'm talking about of re-rating of a company. Investors paying a higher price for the company than they were previously. So in the story fund, I'm focused on many of these companies that I think meet these characteristics. They're companies that have above a 15% year-over-year revenue growth. They're companies that are subscribership based, which I think is the best economic model, and they're growing their subscribership rapidly. They're also companies that have a growing or a dominant market share in their category. And in most cases, they're able to keep that market share. Not always, so all these stories could change over time. All these companies have their own individual story, and I do monitor them, but these are the aspects that I'm looking for. In terms of which ones I buy and when, I haven't really done the strategy of trying to perfectly time every single buy at a dip of these companies. I think that's very difficult to do. If you're always looking for a company that's cheap or at some bargain deal, I think a lot of times that leads you to inferior companies. So what I've done instead is just set up this portfolio similar to an ETF, and I'm just dollar cost averaging into it. So that's what I'm doing with the story fund. I hope this gave you some ideas of growth investing, some different things to look at, and I'll talk to you guys next time.